podcast, everybody. Thank you for joining me. Appreciate it. It's been a while. It's been a crazy market, and just haven't had a lot of time to do a podcast, but I wanted to get this out. Actually, we have about an hour to go before the market closes, and the major averages are kind of bouncing around the flat line, I guess you would say. We are seeing a little bit of relative underperformance in the NASDAQ and an outperformance in emerging markets, which has been interesting to watch in the last few days. So let's go through it. First of all, if you look at the S&P here, of course, we broke down, I guess it was 2 Wednesdays ago, January 20th. And that was the day, if you can see here on this big tail, that was the day the Dow Jones was down about 650 points at one point, reversed. Didn't finish up on the day, but a lot of stocks did, and that was the capitulation day. And from that time, we had a little bit of a rally, about 7% or so, which was capped off last Friday, which was a really strong day. It was a 90% up day. We were up about 380 points on the Dow. And then we come in this week, and it was followed by, on Tuesday, a 90% down day. And these 90% days that I'm referring to is when you have 90% of the points gained or lost, you have 90% of the volume. They're all or nothing days. They're these days where people are saying, get me in at whatever price or get me out at whatever price. And so, last Friday it looked pretty good, and then we come back, and had we seen a mild pullback, that would have been encouraging. But we saw another 90% down day. So what we have done, and of course we have different strategies, and some are still fully invested, some are very, very conservative, and then some are kind of in the middle of the road. On January 4th, which is the first trading day of the year, we pretty much took about 10 to 15% most of our strategies, equity strategies, off the table, out of stocks. And, hindsight would have been better to even go short or lighten up even more. But once we got into this oversold market. It did bounce. I feel like right now we still have some churning around we're going to do. So we actually took some more off the table yesterday in a couple of our equity strategies as well. And I'm going to get into one thing that we did here today where we actually shorted a particular sector. So we'll talk about that. But I've got this yellow box here because I think that's important. If you look at where the market is, you could draw a line right here, and I think this area right here, which is about S&P 2000, is very important. And we could work our way up to that because we've had, obviously, a breakdown below it. We've come up a couple of times. We broke through it. We broke down through it again. So I really feel like this area around S&P 2000, this yellow box, is going to be important for the stock market. And you can see, I think, the market is grinding higher right now. I don't think anybody's got a huge edge because we are having these all or none days, either up or down. But I would just say, for me and for most people, having a balanced approach is really appropriate right now. And what that means is, if you're sitting 100% in cash, and you've been doing it this whole year, you feel great. And you probably felt great last August. And then in October, you look back and say, wow, I didn't think the market could do that, but it's recovered almost all of its losses and very quickly, and you regret that decision, and then you want to get back in only to see it fall back again. So we're churning a little bit here for multiple reasons. Number one, you've got China slowing down, you've got oil falling, and you've got the Fed potentially tightening into a slowdown. Some of you would say we're going into a recession, no question. Some of you would say we're not. I say I don't know, and it doesn't really matter to me because at the end of the day, it's more about how does the stock market react to that. And the market is pricing in a recession right now. Then it's pricing in. And if we have a mild recession, the stock market may have priced it all in already. If we have a, 08, then of course it has not. And so it makes sense that the stock market is churning around going sideways right now because if you think about it, earnings last year were flat. We didn't have any growth. We have the Fed tightening. They ended quantitative easing. And so when you put all that together, people aren't going to pay a premium for stocks. And so some of that premium has coming out. So here we are, 10 to 20% lower on most stocks, some of them a lot lower than that. It kind of makes sense. Now, what you're seeing, though, is, what was holding up, the Googles, the Facebooks, Amazons, Netflix, they're not. In fact, if you look at Google, it came out with really good earnings the other day. And from that time, you can see it's fallen about 11%. This is a company I think I would like to buy if it was to pull back, maybe another 15%, maybe around, if it had a low sixes on it, that would be fantastic. If you take a look at Netflix, it's already broken down. I mean, this thing was running up, and it's broken below its 200-day moving average. It's going straight down, so it should have a rally at some point. But what you'd probably look for is a rally up to some point and then it rolling over again. So Netflix is slowing down. If you look at Amazon, same thing. Remember they came out with their earnings, and the stock was way down, then it recovered, and now you see it falling again below its 200-day moving average. Facebook, maybe the last of the Mohicans, we actually sold Facebook in a day too early. We sold it on the day before earnings, just for full disclosure. Now, we sold it back a while ago. It may have been prior to August, and we had a 30% plus gain, so we did very well on it. We kept a little piece of it, and then, of course, it ran up further. We started to get nervous about it, that, A, it was going to disappoint because it's such a high valuation stock. So we sold it. We would have been better off, obviously, holding it for a few days more, but we still locked in a gain on that. But now you see it reversing. So it reached a high the other day of 117.5, and it's down to 109 as we speak, 110. So it's pulled back about $7. So FANG, F-A-N-G, the acronym for these stocks that have been working, are starting to get hit. What's interesting is in the last few days, you've started to see some stuff like mid-caps are doing well today. You're seeing emerging markets, which has been outperforming since January 5th, has been outperforming the market. So you see emerging markets, which are up about 9% since then. Now, why are they outperforming? They're not dramatically outperforming, but why are they outperforming? Well, you can look no further than the dollar. Look at the dollar here. Remember, the dollar is supposed to be going up right now because we're the best in the world in terms of our economy. So why is it not? Because everybody agrees. And so what's happened is the dollar's been getting hit lately, and that's giving international stuff a boost. So you can make money if international goes up on its own, or you can make money because the dollar's going down in international. Those are two ways to make money. As far as the VIX, you can see here, we kind of got into, I don't have it on the screen here, it's on a different system, but we kind of got into my fear zone where people were freaking out. Once it subsided, it gave you a little more clear sign potentially to buy in the short term. But now I kind of feel like, I don't feel like either side has an edge, but I do feel like maybe the bulls have a slight edge. But I'm just saying I would rather play the middle right now and have a few things in the market and a few things out of the market and let the dust settle a little bit, because the rally we've had from the low here has not still had the intensity that I would like. It could go higher. I think it could go up to 2,000. But if it continues to be this lethargic rally, I would start building short positions. That's the next phase. The first phase was, hey, something happened here, but look how quickly it recovered. So everybody keeps buying the dips. Now you're in this situation where you're like, okay, something bigger is going on, and if we rally back with strong intensity, great, the market overreacted. But if we keep rallying on nothing and there's no leadership, then I think it's going to have to be sold further, and furthermore, it would have to be shorted. Now, speaking of shorts, this is pretty interesting. I don't have it completely on my system, but if you look at utilities here, utility stocks in the beginning of 2015 were way, way overvalued. They're still overvalued. But if you think about it, they are the income trade, right? If people don't want to buy treasuries paying 1.8%, they don't want to sit in a money market, but they sure as heck don't want to buy extremely volatile stocks. So they say, we're going to buy utility stocks because they at least pay us an income. You know, they're paying us 3.5%, 4%. So they got overheated. Well, from that point, utility stocks fell about 18%, okay? And now, if you look at the long-term uptrend, is still intact, going back several years. They're overpriced as an asset class, but I think what's interesting is look in the last few days what's happened. As stocks started to sell off again, people shifted into utility stocks. Now they're really, really stretched, in my opinion. So what we did is we went in and shorted these today in two of our strategies. You can do it through SDP, which is an ultra short utilities. Now, we bought a small piece because this is a double. It's going to move twice as much opposite of utility stocks. So you can see as of right now, it's up about 1.1%. Okay, nothing major. But if utility stocks simply drop 5%, we would expect this to jump 10%. You know, we would expect this to be up here. And we'd probably take that as a trade Okay, that's probably what we would do. So there's two things here. I think utility stocks look interesting from a longer term perspective, but shorter term they're way overdone, and furthermore, fundamentally they're very expensive as well. And I think people think they're a safe haven, but they could get hurt if rates rise, or they could get hurt just because they're overdone, and they've been a safe haven. So I think you win two ways with this out of three. If the stock market moves higher from here, I think people shift back out of utilities and into stocks. That's one way you win. If the stock market completely collapses and we go back and test the lows, which we possibly could do, I think utility stocks also get hurt. Okay? If the only time I think utility stocks are going to do okay in here is if we keep churning around maybe, and maybe the stock market stays a little weak but not too weak, then I think utility stocks could do well. So for us, we think there's two ways to win, only one way to lose. And but look at this picture, guys. This Bollinger Band here, stocks don't typically stay outside of this. This thing's been staying outside of it for 1, 2, 3, 4 days in a row, and it's coming back into it. So again, if we just see simply a pullback, let's just call it to here, we're going to make decent money on this trade from a shorter term perspective. So that's one, again, if you look at it vertically here, this thing has gone vertical, I should say, and could pull back. So that's one we do like. But I think, as far as bonds concerned, here's TLT. I think this is another reason utility stocks are doing okay. But I think TLT could possibly be bought on pullbacks. I would rather buy the whole bond market, because I think adding that as a stabilizer to the portfolio right now makes sense. But there's a lot of companies, even, you look at Starbucks. I mean, it looked like it was breaking out the other day. And these are good companies. Nothing wrong with these companies. But you can see it was a fake out. It broke out, and then it just came back in. And so does that break its 200? So there is a possibility here for a couple of things. I think the indexes the last couple of years have been masked by a handful of companies doing well. And those companies now are struggling. And if those companies struggle and they have the bigger weighting in the indices, you could see the indices not look that great. In other words, you could see the Dow Jones and the S&P going down, but maybe there's a lot of pockets of strength. What if energy stocks, start doing well? The indices aren't going to reflect that, but maybe your portfolio does. As far as oil, this is USO. Of course, oil had that huge day yesterday on a bad report. Sometimes bear markets end on bad news. Maybe we saw that with USO. I don't know if it's the bottom or not. But it's certainly, making higher lows is constructive here. And so the fact that we did get that low on Wednesday, January 20th, we ran up. We got a higher low on February 2nd, a big day yesterday, pulling back a little today, about 2.5%, nothing dramatic. Can we still work our way higher and at least get some stabilization? Because I think once you saw this break, which, again, if we were to look at oil, and I'll switch to oil. This is the ETF that tracks oil, but here's oil itself. And, again, this is a one-day delay. But you can see, we were hanging around in the 40s, mid-40s range, and I think people were going, okay, things are okay. Once we fell below that, that's when you started to see the dividend cuts, more layoffs. And so, again, can we stabilize in 30s, or can we preferably get back in the 40s to 50 range to where at least these companies have a little bit of breathing room? And, again, that's the big question, because right now the stock market's still moving tick for tick like oil, and it shouldn't. But anyways, as we speak, commodities down on the day, emerging markets up about 0.6%. Golds continue to do well. We had a gold position on. We got stopped out of our gold miners, and it reversed, and it was a good lesson. But also gold itself, GLD, we had in another strategy. We had SGOL, which is a competing ETF that we can trade for free. And so you see here, gold wasn't a shock that it moved up. What's interesting about, and by the way, this is a dollar play, so the dollar going down, which I showed you earlier, is why it's going up. But it is running into some, could run into some resistance here. So the gold trade might be over in the short run. Your hope would be, like with oil, maybe it pulls back a little bit. Maybe it even does a inverse head and shoulders now that I kind of look at it here. Could be the case. So this could be your left shoulder. This could be your head. And maybe you get a right shoulder over here. And it doesn't have to be exactly where it is, but you could see something pull back a little bit here and take off. So watch for that, because still in the long run, gold is still in a downtrend. This is just one of those zigzags, and a lot of people have been fooled by it. But could gold start to turn? Obviously, if the dollar keeps going down, gold will move higher. So that is about it. As we speak right now, you can see the Dow Jones looks a little different than the S&P, but it's up about 60 points. And to me, this double bottom may be a little bit too easy. If we were to break to new lows, the panic would set in. And with the cash we have, that's when perhaps we'd put some of that to work once we broke through that and got a real big spike. But for right now, we're still in a slight little uptrend. But like I said, we took some off the table fairly late in the day yesterday. And just, again, not overdoing it one way or the other, but certainly cautious in here because the backdrop as far as the supply and demand still don't look good to me. But, we could move a little higher. And where it is on here, maybe up to the, another 500 points or so. And then you could see it roll back over again. So, all right, that's it. Don't forget eggerscapital.com, and we also have our radio show on every Saturday morning live at 9 a.m. Central on AM 930 in San Antonio, and it's streaming on the web, and it's on our website for the archives as well. So have a good evening, everybody, and we'll talk to you soon.